Welcome to the Anschutz Medical Campus of the University of Colorado. My name is David Clute, and I am the Director of Finance and Administration for the Department of Family Medicine within the School of Medicine. You probably cannot tell from this view, but our campus used to be the Fitzsimmons Army Medical Base before the university bought and moved its health sciences programs here in 2010. We have seen incredible growth on this campus since then. We are on the 6th floor of one of the research towers facing west. You might not be able to see the Rocky Mountains from this height, but you can probably tell that today is not one of Colorado's 300 days of sunshine each year. We are overlooking the academic office building on my right, which is the administrative home for family medicine. We occupy most of the 3rd floor with about 100 faculty and staff. The rest of our department is spread out across this campus and the Denver metro area, predominantly in our clinical facilities and partner institutions. Over the next hour or so, I will be explaining, probably in laborious detail, the financial infrastructure of our department. I can say with confidence that as an academic department of family medicine, we are among the largest in the country, both by headcount and financially. However, just like the people walking the hallways behind me, which we affectionately refer to as an ant farm, we are a small component of the entire Anschutz Medical Campus health science enterprise. As we look at our department's financials, keep in mind that the budget for this entire campus last fiscal year was almost $2.2 billion. Family medicine did, however, make up about 5% of the 5,000 faculty on this campus. So we are small but mighty. Let's proceed to our overview. This is a consolidated look at all financial activity in our department during fiscal year 19, which ended on June 30th, 2019. We will dive into each one of these fund types in detail and provide an explanation of how much money our department used last year, where it came from, and how we keep track of it. This first section in light blue is labeled UCD, which stands for the University of Colorado, Denver. Here are several types of funds that are managed by a system called PeopleSoft, which is owned by Oracle. This software is also known by university staff as the Finance System and Human Capital Management, or HCM, which is its payroll module. Before we dive into the types of funds we manage using PeopleSoft, let's define a term that you will hear frequently in finance circles: SPEEDTYPE. A SPEEDTYPE is an index number that identifies an activity in the general ledger so that separate financial statements can be generated specifically for that activity. In layman's terms, you could think of a SPEEDTYPE as a bank account number, but don't ever say that to a university CPA. The rest of this slide explains what each digit of the SPEEDTYPE represents. The first 3 digits are the most significant. The 6 indicates the Anschutz Medical Campus, and the next 2 digits, which we will reference frequently, indicate the fund type. Now let's dig into the PeopleSoft section of our All Funds view. The first column stands for General Appropriations. The source of these funds is the State of Colorado budget as well as student tuition. We often refer to these funds as state dollars, even though they include tuition. These funds are also known as Fund 10 because the SPEEDTYPE we use for these funds has a 10 after the first digit, which again is a 6. The School of Medicine determines how much our department receives each year. It generally remains the same each year. The only changes I have seen pertain to the financial support we receive for graduate medical education, or GME. That variance, which we've seen go up and down, is known as GME incremental funding. It is a flat dollar amount multiplied by the total number of residents and fellows in our Accreditation Council for Graduate Medical Education, or ACGME, accredited programs. All general appropriation funds are intended to support our educational and research missions, as well as general department administration. It is important to note that these funds represent a very small percentage of our total department budget. This is typical of clinical departments in our School of Medicine. I will also explain later why this low percentage is atypical when compared to other schools and departments across the University of Colorado system. Back to our overview spreadsheet, you'll notice that general appropriation funds paid for the salaries and benefits of almost 10 FTE of faculty, staff, and PRAs in our department. We also use these funds to cover a small amount of FTE outside of our department. As you will see, our department's budget has somewhat porous boundaries because we collaborate in both directions with others. Our total allocation in fiscal year 19 was $1,713,325. We also had unspent funds of $61,487 that we carried over from fiscal year 18. The $83,171 carryover was not part of our general appropriation and is tracked separately since it is earmarked for something specific. Although we always intend to spend down our general appropriation funds completely every year, you will notice that we still had a balance of $49,670 to carry forward into fiscal year 20. The next column of UCD funds stands for Indirect Cost Recovery, or ICR. These funds come from grants, and primarily from federally funded grants, of which we receive the largest percentage of ICR. The University of Colorado is the actual recipient of the grants, and it charges a Facilities and Administration, or F&A, rate on each grant. This rate is negotiated between the university and the federal government, and right now that rate is about 55%. The university charges F&A on all grants, and the rate will vary depending on the sponsoring institution. F&A funds are used to pay for indirect costs related to the direct execution of the grant proposal. The university uses their share of these funds to pay for buildings, utilities, maintenance, and administration. A fraction of the F&A is passed back to the department. That's why it is called indirect cost recovery. Our department is recovering funds from the university to pay for our indirect costs on that grant. We can use ICR funds for operating expenses that are indirectly related to the administration of grants. Note that operating expenses exclude payroll. However, our department received a written exemption to this policy many years ago, which allows us to use ICR to pay for the staff who helped prepare the grant submission, known as pre-award, and the staff who track grant award expenditures and submit required progress reports, known as post-award. ICR cannot be used to pay for faculty or professional research associates. This is why we categorize the available cash balance as restricted for our internal purposes. Our department generally earns very little ICR funding. However, we started fiscal year 19 with a balance of over $145,000. This is related to one very large federal grant which we have had for the last couple of years. We use these funds to pay for 0.64 FTE of our grant administration staff. During fiscal year 19, we recovered an additional $119,000, which gave us an even larger balance to carry forward into fiscal year 20. The next column contains auxiliary funds, which are, as the name implies, ancillary to our department. These funds are generated by enterprising or entrepreneurial activities. The university calls them self-supporting services. Examples in our department include an online e-learning platform, our Advanced Life Support for Obstetrics, or ALSO, continuing medical education course, and royalties from intellectual property that our faculty have sold or licensed to outside companies. A separate speed type is assigned to each auxiliary activity. The proceeds generated by that activity are controlled by the principal investigator, PI, or entrepreneur who leads that business venture. One of the reasons why these activities are accounted for separately is their revenues may be subject to income taxes. The university is tax exempt, but in some cases, the activities that we are involved in could be taxable, especially when they are not closely associated with our educational mission. This is referred to as unrelated business income tax, or UBIT. Speaking of taxes, the University of Colorado collects a tax from us based on our auxiliary activities. This tax is known as a General Administrative Recharge, GAR, or General Infrastructure Recharge, GIR. As the names imply, the university uses these funds to cover the overhead they provide to us. This tax rate can be up to 7% and is calculated based on expenditures, not revenues. Notice that most of the total cash balance is restricted, and this is also a designation internal to our department, meaning the cash is exclusively under the control of the enterprising PI. We covered very little FTE with auxiliary funds in fiscal year 19. We did show some revenue coming in and enough expenses charged to spend that revenue as well as the unrestricted cash balance that was available. The next column is for grants. Grants are one variety of funds that are more generally referred to as sponsored projects, where projects are funded by a sponsor outside of the university. Typically, our sponsors are government agencies, but they can also be foundations, other institutions of higher education, and even private companies. The projects are in support of our education and research missions, and they are coordinated through the university's Office of Grants and Contracts. These are restricted funds in the purest sense. The way in which these funds are to be used is predetermined by the sponsor and the university. Sponsors generally require periodic reports on how the funds have been used and on the progress of the project itself. I referred to this activity earlier as post-award. Another unusual feature of sponsored projects is that they may span across several fiscal years, and they may have beginning and ending dates that are out of sync with the university's fiscal year cycle, which is July 1st through June 30th. Sponsored projects can be accounting puzzles. You'll notice that we have a little more than 6 family medicine FTE charged to grants in fiscal year 19 and 0.59 FTE in other departments. The revenue we received from grants was exactly the same as the expenses charged. There is no profit or residual remaining. This $380,000 is a relatively small amount of money compared to the amount of research performed by our department. This is because we have a collaborative relationship with ACCORDS, the Adult and Child Center for Outcomes Research and Dissemination Science. The overwhelming majority of our sponsored projects are facilitated through ACCORDS. This column only represents grants that are set up through our department. We will discuss this arrangement in more detail later. The next column stands for Academic Enrichment Funds, AEF, or Fund 35, meaning these speed types begin with 635. AEF come from the Dean of the School of Medicine, who has 2 primary sources of funds that he or she can use to enrich the academic mission of the school. The first source is a 10% assessment on all revenues that flow through the practice plan, CU Medicine, which we will discuss in greater detail. This funding stream is sizable and perpetual. The Dean also receives financial support from the University of Colorado Hospital, based on various agreements that have been established between the school and the hospital. It would be appropriate to state right here that these 2 entities, the practice plan and the hospital, are critical to the financial strength of all departments and centers in the School of Medicine. These 2 entities generate an enormous volume of revenue from patient care. Healthcare revenues make the School of Medicine fiscally sound and diversified, and an outlier compared to the rest of the University of Colorado. Other schools on the Anschutz Medical Campus generate some income from patient care, but they are significantly smaller. Back to AEF. When the dean is approached with a request for funding from a department or center, such as recruiting faculty or opening a lab or supporting a program, and when he or she approves that request, the funding usually comes in the form of AEF. Our department had a carry-forward balance of $490,000 from a support package totaling $750,000 that the dean gave us in fiscal year 18. We used the rest of those funds during fiscal year 19. Note that in addition to the carry-forward, we also received an additional $1.54 million in AEF support during fiscal year 19. This large influx of support represents the dean's commitment to backstop several faculty who were displaced from the Rose Family Medicine residency, which closed in fiscal year 18. Altogether, AEF paid for 10.6 FTE in fiscal year 19. The last column in our group of UCD funds represents gifts, which are donated to either the university or the CU Foundation. All gifts are now directed to the CU Foundation. The funds we show here under UCD are legacy gifts, which were given directly to the university in the past. This no longer happens. Each gift has specific requirements on how the benefactor wishes for those funds to be used, meaning they are also purely restricted gifts. Gifts differ from sponsored projects in that the benefactor cannot expect to receive any economic benefit in return. Further, the benefactor has very limited insight into how the funds may be spent. They can request and receive reports, but not because they have any oversight of their gifts. Although gifts are now handled exclusively by the CU Foundation, we access those funds using PeopleSoft SpeedTypes that begin with 634. We'll talk more about the CU Foundation shortly. There is one other university fund type that is accessible through PeopleSoft, of which we have none, which is why they are not on our overview spreadsheet. They are known as plant funds, an archaic term that describes one possible use: to build physical infrastructure. Now, we tend to refer to 672 speed types as reserves or savings. If we generate a surplus in general appropriations or an auxiliary fund and we want to place it into reserve for a future major purchase, this is where we would move them, and they would earn interest. We can do this only after submitting a spending plan to the school and obtaining their approval. Now that we have completed our overview of funds held by the university, let's look at gift funds that live with the University of Colorado Foundation, or CU Foundation, highlighted here in green. They use an accounting system called Financial Edge, which is separate from PeopleSoft. This causes our management of gift funds to be a bit complicated. The CU Foundation is a separate legal entity from the university. It is a 501c3 that was formed in 1967. The purpose for having the foundation separate from the university is to take advantage of economies of scale when all gift funds are in one place and invested by a single entity. The agents of the foundation who help raise funds are now employees of the university and work in the Office of Advancement. This changed a few years ago in order to ensure their alignment with the university's mission. At the end of fiscal year 18, the foundation had over $2 billion in assets, and during fiscal year 18, it grew by a total of 11%. This was higher than usual. It had grown by about 8% annually over the previous 3 years. This is the best rate of return we can get as a department. In other words, if we have excess funds to invest or save, we would get the best return on our investment by placing them at the foundation rather than with the university or with CU Medicine. 3 different types of funds sit with the foundation. First are endowments, which comprise about 80% of the foundation's assets. There are a variety of types of endowments, and the amount required to establish an endowment depends on its purpose. Endowments can be created for as little as $25,000. Endowed chairs, by contrast, require a minimum gift of $1.5 million. Those funds are invested and cannot be used. However, 4% of the current investment balance is distributed into a separate earnings account each July 1st. These are the funds that the fiscal manager of the gift can spend according to the gift's purpose. The earnings accounts also accrue interest. The third type of fund at the foundation is called a current account. It's like a free checking account for us that does not earn interest. They tend to be much smaller in amount and do not have a minimum balance requirement. Small gifts are set up as current funds. The total amount of endowed principal managed by our department started at $9 million last year. Most of this principal is for 4 endowed chairs, all of which were given to our department and the school by the A.F. Williams Family Foundation in Fort Morgan, Colorado. Since these are endowment dollars, they are restricted from use and accrue a return on investment over time. Earnings in current accounts started the year at $1 million. These are also considered restricted, not because we cannot access them, but because each gift must be used according to the donor's wishes. The expenses paid with CU Foundation funds in fiscal year 19 totaled about $290,000, which was almost exactly the amount of revenue we received as distributions from endowments at the beginning of the year. Our total gift revenue, however, was much larger at almost $2.5 million, including about $1.5 million in new gifts, plus an overall increase in market value. The largest gift we received last year was $1 million, the first installment of a $3 million pledge from, you guessed it, the A.F. Williams Family Foundation. Once we raise an additional $7 million, we will name our department after Dr. A.F. Williams. That will be most appropriate too, considering 85% of the $10.6 million we now have in principal came from his estate. Now let's talk about University of Colorado Medicine. CU Medicine was originally known as the Faculty Practice Fund when it was formed in 1981 as a 501c3 not-for-profit entity. Its legal name was later changed to University Physicians, Inc., or UPI, and a couple of years ago it registered the trade name University of Colorado Medicine, or CU Medicine. UPI, doing business as CU Medicine, is a separate legal entity from the University of Colorado and the CU Foundation. It was established to have a symbiotic relationship with the CU School of Medicine. Hence, the leadership structure of CU Medicine interlocks with the School of Medicine leadership. The Dean of the School of Medicine is also the president of the board of CU Medicine. The chairs of the School of Medicine clinical departments sit on the CU Medicine board. And the School of Medicine Senior Associate Dean for Finance and Administration is also the Executive Director for CU Medicine. There are other overlapping leadership positions as well. CU Medicine serves as a fiscal agent for the School of Medicine and its departments for two primary purposes. One, to bill and collect for patient care services rendered, and second, to arrange contracts for other professional services provided by School of Medicine faculty. Since the university's Office of Grants and Contracts also arranges agreements for School of Medicine faculty, each department will typically have a variety of contracts in place through both entities. The University of Colorado's School of Medicine is different from most other schools and colleges in the university because of CU Medicine. Others may have distinct legal entities acting as their agents in certain capacities. However, CU Medicine, as the agency responsible for billing and collecting patient care, provides about 50% of the financial revenues for School of Medicine clinical departments. This makes clinical departments more financially diverse than the rest of the university, and in most cases more financially secure. Most other departments across the University of Colorado system are overwhelmingly dependent on general appropriations and sponsored projects. CU Medicine uses an accounting system called Microsoft Dynamics AX. This makes 3 different accounting systems which speak 3 different languages, making our job of tracking all these funds even more complicated. We have access to the funds at CU Medicine through PeopleSoft, the university's accounting system. They are considered Fund Type 80, which represents agency funds, or funds that are sitting with an entity that is separate from the university. These speed types begin with 680. We can also access our funds at CU Medicine through CU Medicine's systems and procedures. In some ways, that is an easier process, and in other ways, it is more difficult. For example, CU Medicine policies regarding how funds can be spent are different than the university's policies. In some ways, their policies are more lenient, and in other ways, more strict. We rely heavily on our administrative staff to understand both sets of policies and keep us in compliance. When discussing CU Medicine funds, we use a completely different vocabulary. Fund 1 represents operating activities, which are first and foremost clinical revenues and expenses. We use the surplus from our clinical enterprise to support our department's academic mission. This is an allowable use of those funds, and in fact, a critically important value of the School of Medicine, to use clinical profit margins to support education and research. Fund 5 activities are known as standalone, essentially to distinguish them from our clinical enterprise. The funds in this category are related to contracts written by CU Medicine for services provided by our faculty. Although those can be clinical services, most of these contracts are for other types of services. The other reason why standalone activities are tracked separately from operating activities is because the term and cash flows of these contracts do not coincide with our academic year. Fund 5 accounting requires reconciliation outside of our normal fiscal year-end close process. The third type of fund at CU Medicine is called enrichment. This is where accumulated clinical profits sit in reserve and earn interest. CU Medicine requires that we maintain a minimum balance to sustain our operation in the event of a rainy day, and anything in excess of that we can use at the discretion of the department chair. We rarely charge expenses to these reserves. However, a portion of our reserves are earmarked for the faculty who earned them through contract surpluses or special distributions by CU Medicine, but not clinical activities. This portion of our reserves will be expended by faculty throughout the year. On our financial statement, the first 3 columns refer to Fund 1. The first column represents revenues, expenses, and surplus generated by our clinical activities. Miscellaneous transfers reflects some of the financial support we receive from University Hospital, CU Medicine, and specialty clinical departments. They provide these funds to us through various mechanisms, all of which bolster our clinical operations and ultimately boost downstream revenues for them. Notice that this $1.88 million equates to almost half of the surplus we show in our clinical enterprise last year. Although this support is for our clinical mission, its positive impact trickles down to our other mission areas. The next column, labeled F1 Support, illustrates how much of our clinical surplus gets used to fulfill our educational, research, and community missions. With a net profit of only $293,854 for fiscal year 19, you can see that we would be in a terrible financial position without receiving financial support from our clinical partners. Let's talk about that profit margin and what happens to it. First, I think it's significant that at only 1.6% of our total clinical revenues of $17.8 million, it is almost an insignificant profit margin. However, it serves a valuable purpose. CU Medicine bylaws require that at least 50% of it gets paid out to our faculty and that we leave at least 10% of it in our reserve. You can see how this accounting works as the fields highlighted in orange indicate. The Fund 1 profit is transferred to Fund 4 at fiscal year end, and during the first quarter of the following fiscal year, faculty incentive payments are distributed out of that Fund 4 transfer. The amount not paid out remains as reserve. The distribution of these incentive payments to our faculty is governed by a plan document created by our faculty and approved by CU Medicine, which is reviewed at least every 5 years. You'll notice that the salary and benefits expense, $959,811, far exceeds the profit transfer. Most of the salary and benefit expense you see here is due to productivity incentives paid to our clinicians, not our department incentive plan. The funding for productivity incentives, which shows up as $854,870 on miscellaneous transfers, comes from our clinical partners. Our ending Fund 4 reserve position was $1,867,000. When you factor in the $267,000 of faculty discretionary savings, plus the Fund 5 balance of $1,637,000, We are comfortably above the CU Medicine bylaw reserve requirement for fiscal year 19 of about $1.5 million, shown in red below. The last CU Medicine column to explain is Fund 5. As said previously, this standalone activity pertains to revenues and expenses from contractual agreements. Our contractual revenue in fiscal year 19 was $6.7 million. The remaining surplus of $262,723 is misleading, as our contracts typically break even. This surplus exists for the same reason as the starting restricted cash balance of $1.37 million. We have been given funds by the state of Colorado through the Commission on Family Medicine to hold in reserve in the event their current annual financial support of 4 residency expansion slots comes to an end. This accounts for the $1,637,000 we had in Fund 5 reserve at the end of fiscal year 19, which also provides a nice cushion to help us meet the CU Medicine reserve requirement. Our clinical operations supported a total of 78 FTE in our department, and CU Medicine contracts supported another 31 FTE. In total, funds that flowed through CU Medicine supported over 109 FTE in fiscal year 19, which was almost half of the 221 FTE that were on our department's payroll. The blue column outlined in red summarizes all of the funds we have discussed up to this point. Total revenues of $31.3 million and 138 FTE, which are found under our department's name in 3 different accounting systems. This is not our entire budget, however. As a collaborative department with faculty who have relationships with other entities across our campus, we enjoyed an additional infusion of about $6.6 million in revenue that funded another 46 FTE of faculty and staff on our payroll. A large majority of these FTE are faculty who work almost exclusively in university entities with whom we partner, but are not directly overseen by our department, such as the Johnson Depression Center, the Center for Bioethics and Humanities, the Cohen Veterans Network, the Marcus Brain Institute, Accords, the National Mental Health Innovation Center, the School of Medicine Dean's Office, and the Office of the Chancellor. All faculty must receive an appointment from an academic department, and entities such as centers and central administrative units cannot provide faculty appointments. Our department is a primary source for this type of faculty appointment on the Anschutz Medical Campus. The second orange column describes grant revenues and expenses that we run through Accords, which we mentioned earlier. These are grants that are led by family medicine faculty. Their location at Accords is an administrative distinction that, again, underpins our collaborative relationship with that center. These grants funded 37 FTE in our department, as well as 6 FTE of faculty, staff, and professional research assistants who are not on our payroll, but who also helped carry out this research. Note that the bulk of this $19 million in grant revenue was paid out as operating expenses. This reflects innumerable subcontracts with entities across Colorado and other states, all of which were managed by our department's grants and contracts staff. Now we have all of the data to paint a complete picture of our department's finances and payroll. In fiscal year 19, we paid almost 222 FTE in our department and another 9 FTE in other departments. We managed about $57 million of financial transactions during the year and saw our overall reserves increase by $2,341,884 to a grand total of over $16.5 million. Remember that a large portion of that increase was the $1 million gift from the A.F. Williams Family Foundation. When we think about the size of our department, it is important to distinguish between paid FTE and headcount. During fiscal year 19, at our peak, we had 158 faculty, 16 PRAs, 55 staff, and 81 faculty who were employed by affiliates. That's 310 people in our department. In addition, we have over 600 clinical volunteer faculty across the state of Colorado, and a few beyond that, who maintain a formal relationship with our department for various academic purposes. How do we manage budgets? With 3 separate accounting systems for 3 different entities that hold our funds, and a department that continues to grow, our finance team is perpetually refining our process. Generally speaking, we spend March through May working on our budget for the fiscal year that starts in July, and involve a lot of people in many meetings. The university requires us to submit budgets for general appropriations, auxiliaries, and gift accounts, although not at the same time. The deadlines for these groups of funds span from March 31st to mid-June. We fill out a separate form for each auxiliary and gift fund, while our general appropriation budget is detailed on a spreadsheet. Since auxiliary funds are enterprises, we have to estimate how much revenue each activity is likely to generate. Our expenditures of all other university fund types are bound either by their cash balances or by the budget that is allocated to us by the university. Throughout the subsequent fiscal year, we will see the budgeted amounts that we have submitted in the PeopleSoft system and can generate budget-to-actual comparison reports. The university may contact us if at any time we are projected to exceed our budget or run a cash deficit. I think it's valuable to point out that from the perspective of the department, in all of our accounting systems, we essentially manage our books on a cash basis, or as some would describe it, using fund accounting principles. Although all 3 systems have the capacity to track receivables and payables, and they do to some degree, we cannot produce complete accrual-based financial reports that meet generally accepted accounting principles. Our systems are not configured for us to have that functionality at the department level. CU Medicine has provided a tool called De facto that we use to upload our budgets for Funds 1, 4, and 5 into AX. De facto is an Excel plugin that connects to AX, which currently sits on a standard query language or SQL server. With a few exceptions, our department independently forecasts revenues and plans expenses. CU Medicine's finance team will review our budget submission and follow up with questions, after which our budgeted figures are locked in for the next fiscal year. The way CU Medicine uses our budget is of a bit more consequence than the university. Since CU Medicine is essentially governed by physicians for physicians, its financial performance is of great interest to them. Their finance committee produces monthly comparative financial statements that show how each department's clinical and contract revenues stack up against the budgets that were submitted. Personally, I cannot recall a time when any department was publicly embarrassed for falling behind the budgets they submitted. However, the data for all clinical departments is there for everyone to see. As far as accountability goes, the only time I have ever received a phone call from the Chief Financial Officer of CU Medicine was when, during the 4th quarter, we were on track to ending the fiscal year with a significant deficit in Fund 1. As long as you generate a profit, I don't think they are concerned. Finally, as far as the CU Foundation is concerned, we do not submit any budgets for use in Financial Edge. About 2 to 3 months prior to the beginning of a new fiscal year, their CFO sends us notice of how much each distribution will be from endowment principal into their associated earnings accounts. That lets us know how much we will have to spend the following year, in addition to any carryover cash balance in the earnings accounts. That's all there is to budgeting for the foundation as of right now. How does the budgeting process look from inside our department? The core of our budget is programs, each of which has its own sources and uses of funds. Our finance team invests a significant amount of its time compiling this data for program directors. The tricky part is, of course, that most programs have access to funds from any of our 3 accounting systems. Their program budgets are a compilation of numerous funds from all 3. We currently have about 24 programs, all of which get parsed out by accounting system and then rolled up for our overall budget calculations. Clinical care, contracted services, sponsored projects, and indirect cost recovery all contribute department financial sustainability one way or another. However, the revenue that each of them provide is not necessarily driven by the needs of our programs. We have to project these activities independent of the conversations we have with our program directors and then fit everything together. Grants and indirect cost recovery are a further step removed from our annual budget process because the timing of those resources typically does not align with our fiscal year, and how we can use those funds is restricted. We can't wrap up this overview of our budget process without talking about salary setting. Salaries and benefits comprise 80 to 90% of our department's expenditures. Faculty, staff, and PRAs are eligible for an annual raise on July 1st, and we submit those figures to the school in mid to late April. Fortunately, this falls squarely into our annual budgeting cycle, so we have this data available for integration into our fiscal year budget too. Since salaries and benefits impact all fund types and all programs, it truly is an integration. For those in our department who are required to prepare a budget, such as program directors, and specifically those who are requesting financial support from our department, let's talk about what our department can afford and where does that money come from. It goes without saying, but I'll say it anyway, that you're much better off bringing your own funding to the table. Here are examples of how to do that, which we've mentioned throughout this video. What funds does our department have available year over year? Our primary option is our clinical profits. These are, however, unpredictable, in large part because the healthcare industry as an economic sector is dynamic. The way we are funded and supported clinically continues to change, so it is difficult to forecast our profitability. As the only funding stream in our department that usually produces a profit, our clinical enterprise must grow in order for our entire department to grow. The other sources of funds that you have seen in this overview that are in the black are almost all restricted in purpose. However, all of those purposes align with some component of our overall mission, which is why they were given to our department in the first place. If you would like to know whether any of them align with your program, feel free to ask department leadership for more details. As a large department with relatively vast resources in a field of medicine that is not known for being highly lucrative, we rely on collaboration and creativity to remain financially sound. I'd like to conclude this presentation by sharing a secret to our creativity that is best understood by our financial team. Despite our best efforts to predict what will happen each year, it never works out the way we planned. We may have the good fortune of hiring a great person who happens to knock on our door, or we may lose someone who has found greater fortunes elsewhere. We learn that grant submissions have been funded, or that auxiliary activities were not as productive as we anticipated. Most of all, our clinical enterprise is constantly fluid, which casts both light and shadows on our financial outlook. All of this means that the budgets we submit externally can quickly become irrelevant to the internal balancing of our department's resources. Our financial team and executive leadership monitor our status throughout the year and pay particularly close attention as we enter the fourth quarter. Most of our funds cannot go into deficit without immediate consequence, and in a few cases, surpluses must be handled with care as well. With all else under control, our goal is to close each fiscal year with a surplus in Fund 1 from our clinical enterprise. This allows us to pay out a modest incentive to eligible faculty members and add to our Fund 4 reserve. Our Fund 1 position is, of course, primarily dependent on our clinical performance, but not entirely. We have some discretion over how that ship comes into port, so to speak, and it can be tapped and nudged by a few of our tugboats. If we are lucky, we may have some room to shift expenses between general appropriations, gifts, and the occasional Fund 5 contract surplus. We do this primarily using payroll expense transfers, or PETs, moving salaries and benefits that have already been paid from one fund to another. We can also move operating expenses using journal entries. Any use of these techniques must comply with university policies and meet the restricted purposes of affected funds. It's a crafty, delicate, and complex maneuver, which is why I have labeled it as our secret recipe. It's how we keep a $57 million budget that has very little wiggle room balanced. Whew, that might have been more of a deep dive than an overview. Obviously, our finances are complicated. Fortunately, we have an incredible team of smart, hardworking staff who keep us above water, in compliance, and perhaps most importantly, paid. Each of our faculty, staff, and professional research associates is committed to the mission to help people be healthier, and that starts with each other. I believe we have something special going on here in Aurora, and it's called the University of Colorado Department of Family Medicine.